You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
One of our topics these days is Starcore International Mines. They're trading on the TSX. They have two projects in Mexico. One is a producing gold mine, profitable, operating for 30 years. Small mine, 10,000 ounces of gold, but it's generating $8 million in operating profits. And then they have a second project, a large copper moly project, advanced stage as well, which is an after-tax NPV of over $400 million US. But the best part of this company is that its market cap is $10 million Canadian, and they have cash of $10 million.
Hey guys, this is Brian Lenny of MiningStock Education and JuniorStockReview.com. Today I have with me Sid Rajeev of Fundamental Research Corp. Sid, it's great to have you. Since you're new to the show, could you start off by giving everyone an intro into who you are and what you cover in your newsletter?
Absolutely. So Brian, first of all, thank you for having me in your show. So my name is Sid Rajeev. I'm the head of research at Fundamental Research Corp. We're based in Vancouver, been around for 20 years. This is our 20th year. What we do is we do independent equity research on a wide range of sectors, mining, tech, real estate, cannabis, cryptos, you name it. We cover them. And I mentioned we have covered 650 companies in the past. What we do is we independently analyze the company, and then we put a valuation at the end of each report. So that allows an investor looking at the company to take the report, quickly glance through the report, get a feel of what the company is about, look at our projections, and use that as a tool to make their decision on whether to follow the company or invest in the company. But our report becomes a good tool prior to making a decision on a company. But when I want to talk about the independent aspect. I mentioned the largest independent research shop, but how we operate is that we are like auditors. So we get paid a flat fee upfront in cash, paid by the companies or investors. So they hire us, they give us the full amount, a fee upfront. That allows us to be more independent because we're not allowed to invest in any other companies we cover. No back-end fees, no banking, pure research firm. The idea is that would allow us to be more independent than, say, other types of research you see out there.
Sure. Okay. So that brings up a good question then. In terms of doing a report and having an evaluation on a company, does that focus you in on, let's say, I'm going to make all these questions focused on the resource sector. So the mining, that's what most people are interested in that are watching the show. Yes. So, does this make you look at just development companies or producing companies, some things that have resources? Because obviously the exploration companies, it's a little bit more ambiguous on how you come up with the valuation. So are you focused just on that one end then?
Well, actually, on the contrary, our focus is actually microcaps, companies that are underexposed, unknown in the market. We started off 20 years ago looking at very small companies, because those companies did not have analyst coverage. The street was not talking about them. So we came in, produced independent research on them to get them more exposure. And then we slowly started looking at bigger companies. And then right now, I would say 75% of our companies have market caps less than 100 million, very early stage. A few of them, maybe 10%, less than 10 million market cap even. So we covered the entire spectrum, but I would say microcap is our sweet spot. So
just within that microcap space, you have companies that have existing resources, whether it's like 1 million ounces in the ground or 100 million pounds of copper. So there's definitely a way that you can differentiate between those companies and come up with a valuation. So how do you do it with exploration companies that really don't have anything in the ground, and really it's the people and the property and the hope of something? So how do you put a valuation on exploration?
Yeah, so we have the line of thought that every asset has some value attached to it. Be it zero, it has some value. So our goal as analysts is to assign a fair value estimate based on, best information out there. So for early stage companies with no resource estimate, what we do is we look at historic work done on the property, be it drilling or some other kind of work. We have geologists in-house. So geologists and financial analysts work together and we come up with a speculative resource estimate or speculative estimate. But it's going to be very preliminary, very speculative, as I mentioned. But we try to assign a target tonnage or grades and contain ounces or pounds, depending on the metal, based on historic work, and then based on valuation on that. And then when the company does more drilling, we kind of tweak our resources or estimates to be it up and down, and then so it's analyst coverage is an ongoing process. They say that you, as an analyst, you need to be covering a company 24/7. So anytime some new development happen, we have to go back, tweak our models, write a report on it, and inform the market on what we think, and then revise our estimates and valuation.
Okay, that's a great way to do it. So, like how you've modeled the business, you don't really have a sector or a metal or anything that you're focused on per se. Is that correct?
Yes. So we across the board, I would say when some commodities or metals become attractive in some markets, some periods, that time we tend to cover those companies more. So it's kind of seasonal, but gold, silver, and precious metals and base metals have always been in our coverage list. But EV metals, as you can imagine, is brand new. We used to cover a lot of rare earth elements back in the day, but not that many. So it's market dependent, and we do cover across the board all kinds of metals.
Is there anything in particular you're interested in, or you're particularly bullish on, even though you're not focused on it? But is there anything that you like?
Yeah, so we try to catch trends before it's mainstream. So as analysts, again, we keep a track of sector news, look at what's going to be in demand in the long term, and try to seek out those kind of companies and then initiate coverage on them. The idea is by doing this, we can differentiate from other research analysts out there, and then bring all those underexposed stories to our subscriber list, which includes both institutions and retail investors.
Over my course of my career, I've had wins and losses. I think the best learning experiences, while it may not have seemed like it in the time, were those times that I've lost money. Do you have any stories, or do you have a situation where you could tell us about where what you thought was going to happen with the company didn't happen, and what you may have learned from that?
Yeah, no, several times. That's how I probably some people say you kind of learn a lot from the mistakes you've made in the past. So one of our biggest mistakes, or my biggest mistakes, I would say, was back in 2011. I think it was the Fukushima nuclear accident, uranium. So uranium stocks tanked the day after, and then us being bullish on uranium, we kind of recommended uranium stocks. And I personally invested heavily in uranium companies too, but that it didn't materialize. Over the year after the Fukushima accident, stocks kept going down, and the sector was kind of dead for many years after that, until recently. But I never knew it was going to take that long. But then in the end, it picked up, and then now it's doing very well. But so that I would say was one of our biggest, or my biggest, miss or bad calls, I would say. But then over the years, I've had a few of them as well. But I'm glad that our overall performance in the last 20 years have significantly outperformed the benchmark. When I say that, you might need a disclaimer here. Past performance is not indicated future, but what we do for our subscribers is, we cover more than 100 companies at a given point. From those 100 companies, we select some companies that we have high conviction on. We put them in our top picks list, and we track the performance of our top picks, and they have significantly outperformed the benchmark. Like, for example, on average, our top picks are up. I'll just give you the number in a second. Is up about 59% since we initiated coverage. And then when you look at the same time period for the benchmark, which is the TSX Venture, which is down 31%. So that's one reason why subscribers have been coming to us, is that our top picks have been performing well. But that said, several of our top picks have not performed well. But overall, as a portfolio, it has overperformed.
Very good. So let's go back to this talk about uranium. And so, that's definitely a lesson I've learned myself. Like I've been bullish on certain metals, especially earlier on in my career as an investor. And I definitely paid the price for being overly bullish or trying to be contrary in the market. So what lesson did you learn, or how do you protect yourself in the future from making that same mistake? You have let's not necessarily a Fukushima, but let's say you have an event in the future that affects uranium or affects lithium or affects gold, and the price comes back and it looks like a good opportunity. So how do you protect yourself?
Well, two things I learned from that is, number one, don't jump into conclusions don't think based on emotions.
Right.
Because one nice thing with the metals market, commodities market, is unlike most of the sectors, it's very simple if you approach it purely based on the fundamentals, supply and demand. You should kind of ignore all the other noise that goes around in the metal. Just look at the supply forecast, just look at the demand forecast. Are you expecting a supply deficit or a supply surplus? That will give you a direction of the metal prices going forward, number one. Number two is kind of trying to time a market. It's almost impossible to time markets. Even the experts say that. So, when you come up with a conclusion or an idea, maybe say gold. Let's say gold is expected to do well. It's very difficult to time and say when gold has bottomed or when gold has peaked. But if you believe in your thesis, stay in there for long term, at some point over the maybe months or years, your thesis will work out. So I think those two things. One is don't jump into conclusions, don't think with emotions, and second thing is don't time. If you believe in your thesis, stick to it for the long term.
Oh, that's sage advice. Yeah. After dismal 2022, the resource sector sentiment seems to have picked up in the last month or so. I don't know if you agree. But my question is, do you think it's real, and do you think it'll continue in 2023?
Well, I kind of have mixed feelings for this year. So as I mentioned, we cover all different sectors, but in terms of, if you're asking for my outlook on the big picture, we are bullish on precious metals, gold and silver, but not so much for base metals or EV metals. Again, going back to my previous comment, supply demand, most of the base metals and EV metals are expected to be in a supply surplus markets, or if they are in a supply deficit, the deficit is shrinking. And these two scenarios are not good for prices. So we are expecting correction in base metals and EV metal prices, but very bullish on gold. A lot of reasons. If you want me to walk through them, I can do. But then,
well, give me your biggest reason why you think precious metals is going to go forward higher.
Well, number one catalyst would be, I think the Fed is likely to turn less hawkish in the coming months. Slower GDP growth, inflation has started to taper. I feel unemployment will go up. During the pandemic, almost 3 million people in the US left the workforce. Labor participation rate is very low. So when these guys eat into the savings, they're going to rejoin the labor force market, and that should result in higher unemployment. So these factors should prompt the Fed to turn less hawkish, and that is good for gold prices.
Okay. What about geopolitics? The Russian-Ukraine conflict obviously probably being arguably the biggest one right now.
100%. So you asked me for the biggest reason, but that's my second reason. Second reason is geopolitical risk.
Okay.
When Russia invaded Ukraine in February of last year, gold prices were up from $1,800 to $2,050. $250 increase in just 1 month. So, and then historically, gold has always been nice when there are geopolitical tensions. So, and we expect a prolonged period of tensions between the West and East. So, any bit of uncertainty or global risk that should spike gold prices. And the third reason for gold is rising production cost. Production cost is up 13% in the last year, when gold was only up 7-8%. So prices are not rising with production costs. So a lot of factors to drive gold prices. One thing we do to forecast gold is we look at money supply, US M2 money supply and gold. The relationship between those two have been very strong in the past 30 years. And if you look at those two relationships, we feel gold should be in the 2000 to 2050 range, per ounce range this year.
So, external risks for all intents and purposes are uncontrollable. Yet usually the risk that's most often thought of. With that in mind, does it make more sense for investors to concentrate on which they can control, that being themselves?
You mean in terms of macro?
Well, just what we all discuss is usually external stuff, where it's geopolitics, it's metals markets, supply and demand. It's all these things that investors really can't control. Yet it seems to be the concentration. So my question is, all those are external, and since you can't control them, does it make more sense at this period in time to maybe look on themselves and how they can be better as an investor? Because just in my experience, most of the mistakes I've made, or all of my mistakes, have been my own mistakes. And to me, it's one of the first things that comes to mind. And I just wondered what you think.
Yeah, no, I think it's good to cut down investments and increase investments depending on the market. But I always feel that you have to be exposed to the markets at all times, but in different degrees. If you're expecting a market collapse, well, you still need to be exposed to capitalize on that. In terms of when it comes to junior resource, I am still a strong believer of following strong management teams. I know everyone says that, but that really does work. I mean, the probability of success is much higher. Even if you have no idea what the company is doing, what the target commodity is, but if you're following a successful management team, the probability is much higher. If anything happens to the market, anything happens to the project, we can be assured that the management team will go and seek a new project, do something to make sure the investments are fine. All and most of these management have skin in the game, so they are well incentivized to protect your investment. So, going back to question, I think at all times one needs to be exposed, but varying degrees.
Okay. This week we saw some really exciting news out of the M&A side of the resource sector, with Newmont looking to acquire Newcrest. I was wondering if you had an opinion on the deal and whether you think it might prompt other senior miners to look at M&A too.
Yeah. So Newmont's Newcrest deal was not a big surprise. Newmont being a $40 billion market cap company is much smaller than Newcrest. I think it's 15 billion. The $17 billion acquisition, the market didn't like it at all. Newmont shares were down 10%, I think. Newcrest shares were up. And that's an indication that the market thinks Newmont is overpaying. And I feel the same. When you look at the $17 billion multiple acquisition, that is about 30% premium over the sector average multiples, like the enterprise value to revenue or EV to EBITDA. I think Newmont is overpaying and the market reacted correctly. But this is the second biggest acquisition in the past few months. As you know, Pan American is acquiring Yamana for $5 billion. And these are indications that the mining sector believes that the sector is oversold. So I feel that more M&A is to come this year.
Okay, yeah, because it's really been the mark or the hallmark of a great market is when that M&A heats up, and really for a lot of these juniors, it seems to be the best way out, or investors to make that profit and get out of that position. I've looked at a lot of junior companies over the course of my career, and one thing that stood out to me is that the market often values exploration companies sometimes higher than development companies, even though they have no tangible stuff in the ground. So in your view, why does the market value hope more than reality? And second, does this phenomenon have any influence on how you buy and sell in the market?
Yeah, so I think I have mixed feelings on that. Right now, I mean, juniors have been underloved by the market for more than a year. Even though we are seeing, gold is at $1,900, copper over $4. These are phenomenal numbers when you compare to historic average metal prices. But juniors have not followed, so juniors are not getting any love at all. But in terms of what you are saying, multiples, Yes, juniors some at times do get higher multiples, and it's two reasons. Number one is it's dominated by speculative investors. They tend to be more optimistic than pessimistic, so they tend to apply that kind of those premiums to that. Number two is always the growth potential. Similar to what we see in tech companies, why is Tesla trading at such a high multiple versus Toyota or Volkswagen or other companies? It's all the earnings growth potential. Similarly, resource companies or early stage resource companies are trading in multiples, higher multiples, because of the market's expected resource growth for those companies.
Very good. Do you have a top pick that you'd like to share with us?
Yeah, so several, but since we talked about gold, one of our top picks these days is Starcore International Mines. They're trading on the TSX. They have two projects in Mexico. One is a producing gold mine, profitable, operating for 30 years. Small mine, 10,000 ounces of gold, but it's generating $8 million in operating profits. And then they have a second project, a large copper moly project, advanced stage as well, which is an after-tax NPV of over $400 million US. But the best part of this company is that its market cap is $10 million Canadian, and they have cash of $10 million, meaning the market is assigning zero value to these two assets I mentioned, especially one which is producing $8 million in operating profit. So in my view, that is rarely seen in capital markets, where a profitable company is staying is trading close to cash. That's one. Second one I would talk about is I like lithium. Even though EV metals are expected to correct, prices are expected to correct this year, I feel I'm very bullish on EV metal juniors because large battery manufacturers, miners, technology companies are actively looking to acquire juniors who can produce long-term stable sources of EV metals. So I'm bullish on juniors, but not necessarily metal prices. And there, lithium, I want to mention a company called Lithium Chile, brand new project in Argentina. They just came up with a resource estimate late last year, and they're coming out with a new resource estimate in the coming months. So that's another story we are strongly monitoring.
Okay, so do you think the lithium boom can continue? It's been red hot, especially in the last, let's say, 2 weeks. We've seen companies around, Patriot, that have just gone through the roof.
Yes.
And so do you think this can continue?
Metal prices, I don't think so. If you look at just the metal prices, most of they used to trade at $5,000 per ton, $6,000 a ton for lithium carbonate, LCE. It ran up to $80,000-$90,000 a ton, and now it's about $70,000. Most of the PEAs are done based on $10,000 to $15,000 a ton, and still the NPV you get billions, in billions of dollars. But I don't think $70,000 a ton is sustainable. So I do feel there should be correction, but the market for juniors should remain hot based on the reason I mentioned earlier due to M&A. Any company that is able to delineate a decent sized resource, attractive PEA or a feasibility study could be a potential acquisition target, especially in a safe jurisdiction.
And what would you say is a decent sized resource?
Well, anything that could provide a mine life of at least 20 years.
Okay.
So 20 years in production and a reasonably attractive jurisdiction should be favorable in these markets.
And is there any preference like brine versus hard rock?
No, not really, because it's difficult to kind of come out and generalize and say brine is better, hard rock is better. Every commodity or every project has its own characteristics. Some brines are obviously lower costs, but then they can also be very low grades. Lower costs is in lower capex to production, but they can also be in very low grades. So it's difficult to generalize, but we are looking at both types of projects.
So just before we end here, I was wondering if we could do, so the response would just be bullish or bearish, and it would be the outlook for 2023. And so I've got a list of metals. Are you game?
Oh, for sure. Yes.
Okay.
Yeah.
So we'll start. We'll say copper.
Bearish.
Lithium.
Well, you're going to get a lot of bearish from me. Yeah. Okay. I'll yeah. So bearish. Yes.
Lithium.
Bearish on the metal price, but bullish on juniors, active the equities.
Oil.
Bearish.
Platinum.
Bearish.
Palladium.
Bearish.
Rare earths.
See, it's difficult to it's wide spectrum.
It is.
So I wouldn't want to make a comment on the entire sector.
Okay.
I would just say maybe I don't know enough of those, so I would say neutral.
That's fair. That's fair.
Yeah.
Uranium.
Bullish.
Nickel.
Nickel, I'm very bullish on nickel juniors equities, but not on the actual metal prices.
Okay. Do you think just a question on that? Is that driven by what's going on with Indonesia and their ability to supply nickel matte to the world? Is that the root of it?
Well, in terms of correction prices, the market is already in a supply surplus last year, and this surplus is expected to increase partly because of the Indonesian. So the lower demand from slower GDP and increased production is why we think a correction is due. But nickel is so important for EV batteries. Even one of our clients recently, Giga Metals, they have a huge project in BC. Mitsubishi went in, and this project gave a negative NPV a few years ago when they did a PEA based on $8 or something per pound nickel. Mitsubishi came in and acquired a 15% interest in this project just a few months ago. So I strongly feel that large nickel projects should do very well in the coming 12 months.
Okay.
Yeah.
Gold.
Very bullish.
Silver.
Bullish. Yes.
Excellent. Okay, Sid, I really appreciate the time and the comments. Some really good points on the metals markets. Where can people find you?
So researchfrc.com. Our company name is Fundamental Research. We also have a YouTube channel, Fundamental Research Corp. But I encourage you to start with our platform, researchfrc.com. Check out some of our sample reports. See is that something that you like. We have options for free and paid subscription. I would suggest start with free. Check out, see if that's something that you like, and then you can choose how to move forward from that.
Very good. Okay, we'll talk to you soon. Bye.
Thank you so much, Brian, again. Have a good day. Bye-bye.